Subscribe for real updates on gold, silver, and money. No hype, just facts that protect your wealth. It is Sunday, January 25th, 2026. The markets are closed. Silver closed the week at $13 per ounce in the United States. In China, on the Shanghai Futures Exchange, it closed at $150. And gold is sitting right at the doorstep of $5,000. The banks threw everything they had at this market. They used margin hikes. They used flash crashes. They used the media to spread fear. And yet, here we are entering the weekend comfortably above the century mark. $100 is no longer resistance. It is support. The ceiling has become the floor. But while the price action is historic, it is the context of this weekend that has traders terrified to hold a short position. We are watching a geopolitical storm gathering in the Middle East that threatens to upend the global order, and we are watching a breakdown in the internal plumbing of the silver market that suggests the system is out of cash. In this deep dive, we are going to walk you through the weekend war room. We are going to connect the dots between the aircraft carriers in the ocean and the empty shelves in the coin shop. But first, we have to look at the war premium. We have received reports that the Abraham Lincoln Carrier Strike Group is arriving in the CENTCOM region this evening. This completes the largest United States military buildup in the Middle East in history. Now, I'm not a military analyst, I'm a financial analyst, but I know how markets react to the sound of war drums. Uncertainty is the enemy of paper assets. When aircraft carriers move, smart money moves. It moves out of currencies that can be devalued to fund a war, and it moves into assets that have no counterparty risk. History tells us that war is inflationary. It requires massive deficit spending. It disrupts supply chains. It spikes the price of oil, and what acts as the ultimate hedge against war, inflation, and supply chain disruption? Gold and silver. The arrival of that carrier group is a geopolitical put option under the price of precious metals. It means that even if the industrial demand slowed down, which it hasn't, the fear trade is taking over. If you are a hedge fund manager sitting in London or New York, are you going to trade against gold and silver this weekend? Are you going to hold a short position while the news cycle is dominated by military escalations? No. You're going to cover, you're going to get flat, or you're going to get long. This weekend anxiety is what drove the price to $13 on Friday. It was a scramble for safety. And look at gold. We are trading just below $5,000. 40,900 or 90 something. $5,000 is a magical number. It is the kind of number that wakes up the general public. It is the kind of number that makes the nightly news. When gold breaks $5,000, a milestone that now appears imminent, it validates the entire precious metals complex. It tells the world that the dollar has lost 99% of its purchasing power since the Federal Reserve was created. Silver is the high beta sibling of gold. When gold runs, silver sprints. If gold is $5,000 and we apply the historic monetary ratio of 15 to 1, historic ratios suggest an implied value for silver of $333. At $13, silver is still lagging. It is still the cheapest asset on the board relative to gold. This value gap combined with the war premium creates a setup for a violent gap up when the electronic markets open on Sunday evening. But there is something else happening, something that isn't on the news, something that is happening in the back offices of the bullion dealers. We have found the reason why the supply chain is snapping. And it isn't just because people are buying, it is because the wholesalers are broke. We have obtained a letter from the CEO of SD Bullion, Dr. Tyler Wall. And in this letter, he describes the current state of the wholesale market as an absolute circus. He reveals that the major players in the industry are maxed out on their credit terms. They have run out of money. And because they have run out of money, we are seeing market anomalies that shouldn't exist. We are seeing a market where dealers are no bid on certain products. Even though demand is at record highs, this is the credit freeze we warned you about. The high price of silver has blown up the balance sheets of the middlemen. They can't afford to finance the inventory anymore. This creates a paradox. You have a war driving demand up, you have a shortage driving price up, but you have a broken financial system that can't move the metal to the buyer. This is how you get a super spike. When the mechanism of distribution breaks, the price has to rise to a level where it forces the metal out of hiding without the need for credit. It has to rise to a level where cash is king. The weekend war room isn't just about geopolitics. It is about the collision of kinetic war and financial war. The U.S. Navy is deploying in the Middle East. The bullion banks are deploying in the futures market. And the wholesalers are bleeding out in the middle. We are going to break down this SD Bullion letter in detail. We are going to explain the 90% silver anomaly. Why wholesalers are refusing to buy junk silver even though they have no eagles to sell. It sounds crazy, right? Why would you turn away silver when you're sold out? The answer lies in the time lag and the credit stress. It is a technicality that offers a massive opportunity for the individual investor who knows what to look for. But for now, understand this. The close at $13 was a victory. The banks tried to paint the chart red. They failed. The market absorbed their selling and closed at the highs. This means the path of least resistance is higher. The Shanghai price of $115 is the magnet. New York is $12 behind. That gap represents the arbitrage profit that is sucking silver out of the West. As long as that gap exists, the price in New York is under immense pressure to rise. We're entering a week where the news flow will be dominated by war, inflation, and shortages. If you're holding physical silver, you're sitting in the lifeboat while the Titanic hits the iceberg. The $13 price tag is just the admission fee. The next phase of volatility appears imminent. In the next part of this deep dive, we are going to open the SD bullion letter. We are going to analyze the absolute circus comment. We are going to explain why money velocity is killing the wholesalers, and we are going to show you why the hedging trap we discussed in previous videos has finally claimed its first victims. The banks are insolvent. Now the wholesalers are illiquid. The system is crumbling from the inside out. And all of this is happening while the aircraft carriers move into position. Buckle up. The war room is open. While the world watches the price of silver tick over $100, assuming that the bullion dealers are popping champagne and counting their profits, the reality on the ground is starkly different. We have obtained a letter that rips the curtain back on the internal machinery of the precious metals market. It is from Dr. Tyler Wall, the CEO of SD Bullion. For those who don't know, SD Bullion is one of the big 3 online retailers in the United States. They move massive volume. They have their finger on the pulse of the wholesale market. And Dr. Wall does not mince words. He describes the state of the wholesale market this week with 2 words: absolute circus. When the CEO of a major financial firm calls his own industry a circus, you need to stop and listen. He isn't talking about clowns and elephants. He is talking about chaos. He's talking about a breakdown in the orderly function of trade. But the most terrifying sentence in his letter isn't the headline. It is the explanation. He writes, "It is becoming increasingly obvious that many large participants are either at or very near their maximum credit terms." Let's unpack that. Maximum credit terms. To understand why this is catastrophic, you have to understand how the bullion business actually works. It is a business built on borrowed money. Wholesalers do not buy silver with cash from their checking account. They use revolving credit lines provided by big banks. They borrow $50 million, buy silver from the refiner, ship it to the retailer, get paid, and pay back the loan. It is a high volume, low margin conveyor belt. But here's the trap. Those credit lines are fixed in dollar amounts, not ounce amounts. When silver was trading at $25 an ounce, a $10 million credit line allowed a wholesaler to finance 400,000 ounces of silver. That is a lot of metal. It kept the conveyor belt moving. But today, with silver trading at $103, that same $10 million credit line only buys roughly 97,000 ounces. The purchasing power of the wholesaler has collapsed by 75%. Not because they lost money, but because the price of the asset they deal in rose faster than the bank's willingness to lend. They are maxed out. They have hit the ceiling of their credit cards. And because they are maxed out, they cannot buy new inventory. This explains the paradox we are seeing. The demand from the public is at record highs. People are waving cash, begging for metal, but the shelves are going empty because the wholesalers physically cannot finance the restock. The pipe has shrunk. Dr. Wall mentions another critical factor. Money velocity is extremely high. In economics, velocity is usually good. It means a booming economy. But in a logistics system with finite capacity, extreme velocity is a disaster. It causes friction, it causes heat, it causes parts to seize up. Transactions are happening faster than the settlement systems can clear them. Dealers are selling inventory before they have paid for it. Wholesalers are shipping metal before the refiners have cast it. The entire system is redlining. And this brings us back to the hedging trap we discussed in our previous report. Dr. Wall confirms our thesis explicitly. He writes, "The cost to maintain hedging accounts has skyrocketed, which further limits how much inventory firms can carry on their shelves. This is the nail in the coffin. Wholesalers hedge their inventory by shorting futures contracts. As the price of silver went vertical to $13, those short positions bled cash. The margin calls drained the liquidity that should have been used to buy new metal. So, you have a triple threat. 1, the price rise reduced the ounce purchasing power of credit lines. 2, the velocity of money clogged the settlement plumbing. 3, the cost of hedging drained the operating capital. The result is an absolute circus. It is a market where the price is screaming buy, but the infrastructure is screaming stop. This credit collapse is the reason we are seeing the no-bid anomalies. Why would a wholesaler refuse to buy back silver? It isn't because they don't want the metal. It is because they don't have the credit capacity to take it onto their books. If they buy your silver, they have to hedge it. Hedging costs, cash. They don't have the cash, so they say no bid. They are turning away business because they are technically insolvent on a liquidity basis. This is a systemic failure. It means that the price of silver has risen to a level that the current financial infrastructure cannot support. The banks built a system designed for $20 silver. They did not build a system for $100 silver. And now the system is breaking. For you, the investor, this confirms one undeniable fact. The shortage is real. If there were plenty of silver and plenty of credit, the wholesalers would be flooding the market. The fact that they are maxed out tells you that we have reached the physical limits of the market. We're entering a phase of allocation. That is a polite word for rationing. The wholesalers will only sell to their biggest, most reliable partners. They will cut off the small coin shops. They will cut off the independent dealers. We are seeing the consolidation of the industry in real time. The weak are deteriorating. The strong are surviving. But even the strong are struggling. SD Bullion is one of the giants, and even their CEO is calling it a circus. This letter is a warning. It is telling you that the buy button might not always work. It is telling you that the inventory you see on the website today might not be there tomorrow. Not because someone bought it, but because the dealer couldn't finance it. The credit freeze is the invisible hand that is strangling the supply, and it leads to strange, distorted behaviors in the market. It leads to price dislocations, where some products trade at massive premiums, while others bizarrely trade at discounts because nobody has the cash to buy them. In the next part of this deep dive, we're going to examine the strangest anomaly of them all. Dr. Wall mentions something that defies all logic. He talks about no bids on a specific type of silver, a type of silver that should be the most valuable in a crisis, but is currently being rejected by the refiners. We are talking about 90% silver, junk silver, constitutional money. Why are wholesalers refusing to buy the most trusted form of silver in America? The answer lies in the time lag. It is a technicality of the refining process that becomes deadly during a credit freeze. We are going to explain why this anomaly is the greatest buying opportunity of the weekend. While the whales are fighting for bars they can't get, there's a window to buy fractional silver that the system is temporarily rejecting. It is a glitch in the matrix. And we're going to show you exactly how this mechanism operates. The circus is in town. The credit lines are snapped and the clowns are running the bank. We have uncovered a market anomaly that defies all conventional logic. It is a glitch in the matrix caused by the breakdown of the credit markets. In a normal silver bull market, junk silver, pre-964 US dimes, quarters, and half dollars, commands a massive premium. Why? Because it is fractional, it is recognizable, it is the ultimate doomsday money. When people panic, they usually rush into junk silver first. But according to the letter from SD Bullion CEO Dr. Tyler Wall, the exact opposite is happening right now at the wholesale level. He writes, "What really stood out was the complete lack of bids from many refiners and large wholesalers on 90% silver." He goes further. He notes that despite the record demand for silver overall, they are seeing secondary products trade under spot. Under spot. Let me translate that for you. Silver is trading at $13 an ounce, but wholesalers are so desperate to get rid of their junk silver that they are willing to sell it for less than the paper price. They are dumping the most trusted, recognizable silver coinage in the world at a discount, while simultaneously charging massive premiums for modern eagles. Why is junk silver bad? Has it lost its silver content? No. A pre-64 quarter is still 90% silver. It is still history in your hand. The reason they are rejecting it is not because of the metal. It is because of the time. This brings us back to the credit freeze we discussed in part 2. To a wholesaler or a refiner, junk silver is dirty. Not literally dirty, but chemically dirty. It is 90% silver and 10% copper. You cannot sell a bag of dimes to an industrial user like Samsung. Samsung needs $9.99 fine silver. So to turn junk silver into industrial inventory, you have to send it to a refinery. You have to melt it down. You have to separate the copper. You have to cast it into new bars. That process takes time. It takes 2 weeks, maybe 4 weeks, depending on the backlog. In a normal market, 4 weeks is nothing. But in a liquidity crisis, 4 weeks is an eternity. Remember, the wholesalers are maxed out on their credit lines. They are paying exorbitant interest rates. They are facing daily margin calls from the comics. They need cash now. They need to turn over their inventory in 24 hours, not 24 days. They cannot afford to have millions of dollars tied up in a smelter for a month, waiting for the metal to be refined. So they stop buying it, they go no bid. And for the inventory they already have, they dump it. They are willing to take a loss on the junk silver just to get the liquid cash they need to pay the bank or buy the fast-moving inventory like Eagles and Maple Leafs. This is a liquidity discount. The wholesalers are valuing speed over value. They are throwing away the baby with the bathwater because they are drowning. But here is where you come in. You are not a wholesaler. You do not have a credit line with JP Morgan that is about to explode. You do not have margin calls. You do not need to refine the silver to sell it to Samsung. You are a stacker. You are holding for the long term. You are holding for the currency collapse. To you, silver is silver. For those who acquire constitutional silver, government minted, legal tender, fractional silver at a discount because the wholesalers are broken. That represents a historic divergence in value. You're buying the asset that the smart money is forced to liquidate. This is exactly what Warren Buffett did in 1997. He bought silver when nobody wanted it. He didn't care about the form, he cared about the ounces. Dr. Wall admits in his letter, SD bullion could literally wipe out that inventory simply because there's no real depth behind it. He's telling you that this anomaly is temporary. It exists only because the market is disjointed. Smart players like SD bullion and you are stepping in to sweep up this cheap silver. Once that inventory is gone, it is gone forever. Junk silver isn't being made anymore. The supply is finite. When the credit freeze eventually thaws, or when the price resets high enough to make refining profitable again, the no bid has the potential to flip into a panic bid. The premiums on junk silver will explode back to 20 or 30% over spot. But right now, in this brief window of chaos, it is the unloved stepchild of the market. This validates our physical manifesto. The paper price is just a reference. The real market is fragmented. In one corner, you have new silver trading at a premium because it is liquid for the banks. In the other corner, you have old silver trading at a discount because it is a liquid for the refiners. But in the hands of a private investor, old silver is actually more liquid. It is easier to trade a quarter for a loaf of bread than it is to trade a 100 bar. If you believe we are heading into a period of breakdown, a period where the dollar fails, then junk silver is the superior asset. It is the ultimate barter tool. And right now, the broken financial system is subsidizing your purchase of it. This paradox, sold out of eagles, no bid on junk, is the clearest evidence yet that the market mechanism has failed. Efficient markets do not allow identical assets to trade at vastly different prices just because of their shape. This is an inefficient market. It is a broken market. And in broken markets, the profit goes to those who understand the plumbing. The plumbing is clogged with junk silver. The refiners can't process it fast enough. The banks won't finance it, so they are leaving it on the table for you. This connects to the geopolitical situation. If war breaks out in the Middle East and supply chains tighten further, the refining lag will get worse. Energy costs will spike. Smelting silver requires energy. If energy gets expensive, the cost to refine junk silver goes up. This might keep the no bid from wholesalers in place for longer than people expect. But for the stacker who holds the physical coin, the energy cost is irrelevant. You already own the finished product. You own the trust. So the implication for the weekend war room is clear. One must look for the anomaly. The astute observer monitors the local coin shop to see if they hold 90% silver and, more importantly, where the price is set. If they are following the wholesale trend, they might be selling it cheap just to clear their books. They might be prioritizing cash flow. The no-bid headlines should not induce fear. They are merely institutional noise. The private stacker becomes the liquidity provider of last resort, and a discount is the logical premium to expect for providing this service. In the next part of this deep dive, we are going to look at the Monday gap. We have the $13 close, we have the war, we have the credit freeze, and now we have the dumping of secondary products. All of these forces are converging on the Sunday night open. And we are going to explain why the uncertainty mentioned in the letter sets the stage for extreme volatility. And we are going to include a critical message for our community about sticking together in this chaos. The wholesalers are confused, the refiners are stalled, the banks are scared, but the math remains the same. Junk silver is 90% silver and silver is money. Everything else is just credit, and credit is dying. We have analyzed the credit freeze. We have analyzed the paradox of the no bid on junk silver. But there is one more revelation in the SD bullion letter that is arguably the most counterintuitive signal of the entire weekend. In the middle of the biggest bull market in 40 years, with silver hitting $13, the wholesalers are not holding out for higher prices. They are selling. In fact, they are dumping. Dr. Tyler Wall writes, "A lack of available financing is forcing other wholesalers to dump inventory as quickly as they get it." And let that sink in. Dump inventory. This is the language of a crash. You dump stocks when the market collapses. You dump assets when you are panicking. You do not typically dump silver when it is breaking all-time highs, and aircraft carriers are sailing into the Red Sea. So why are they doing it? It brings us back to the liquidity crisis. The wholesalers are not selling because they hate silver. They're selling because they are starving for cash. Imagine you are a wholesaler. You have $10 million in debt coming due on Monday. Stay tuned for the conclusion. The circus is about to become a rocket launch. We have arrived at the conclusion. If you have been with me through this entire briefing, you now possess a rare picture of the silver market. You understand the war premium, the credit freeze, the 90% anomaly, and the distressed selling. We have looked at the puzzle pieces individually. Now, we must put them together. It is Saturday, January 24th. The US price is $13 and the Shanghai price is $115. Gold is knocking on $5,000. The stage is set for what traders call a gap and go. We need to talk about what happens when the electronic markets open on Sunday evening. Markets hate uncertainty, and this weekend is defined by uncertainty. We have the uncertainty of war, the credit collapse, and the Shanghai spread. When traders face this much uncertainty, buy orders pile up in the system. Because the market is closed, those orders cannot be filled. The pressure builds. When the market finally opens on Sunday night, that dam breaks. If there are more buy orders than sell orders, the price does not tick up gradually, it gaps. It jumps instantly to $105 or 18. It skips the prices in between. This Monday gap is the mechanism by which the US market tries to catch up to Shanghai. That $12 gap is an arbitrage vacuum. It is a distinct profit opportunity. Economic gravity pulls toward it. So the base case for the opening of trade is a violent move higher. But here is the danger for the retail investor. A gap up is often followed by extreme volatility. The banks, still trapped in their short positions, will try to use the gap to short the market again. They will try to create a flush to scare the new buyers out. This brings us back to the absolute circus described by Dr. Wall. If the price gaps to $110, it does not mean the wholesalers are fixed. In fact, it makes the problem worse. If the price goes higher, the credit crunch intensifies. A higher price on Monday breaks the physical supply chain even further. You might see $110 on the screen, but dealers might be sold out across the board. This is the disconnect. The paper market is reacting to the war. The physical market is reacting to the credit failure. They are moving in the same direction, but the physical market is breaking down structurally. So, what is the final verdict for the week ahead? We are entering a period of price discovery in a broken market. Price discovery is a fancy term for chaos. Nobody knows what the real price is because the futures market is decoupling from reality. Is silver worth $13 or $115? If you ask the COMEX, it is $103. If you ask Shanghai, it is $115. If you ask the wholesaler dumping inventory, it might be $95. If you ask the refiner who can't get credit, it might be no bid. But if you ask history, the answer is much higher. Gold at $5,000 tells us that fiat currencies are entering their terminal phase. Silver is simply catching up to the debasement of the dollar. Strategy number 1, the circus is noise. Attempting to trade this market is perilous. One cannot outsmart a broken machine. Strategy number 2, identify the discount. If one finds a dealer selling junk silver at a discount, the opportunity exists. The private investor acts as the liquidity provider. That is how wealth is built. Strategy number 3, watch the war premium. If the situation in the Middle East escalates, the safe haven bid will overwhelm everything else. If the aircraft carriers start launching planes, silver won't stay at $13. We're standing on the edge of a new world where counterparty risk is everything. The wholesalers have risk with the banks. The banks have risk with the exchange. But if you hold physical silver in your own possession, you have eliminated counterparty risk. The public is just waking up. They are buying because they are scared, not because they understand. When they realize the dollar is mathematically doomed, the buying will turn into hoarding. We are early. We are right. And we are sitting at $13. The gap is coming, the war is looming, and the vaults are emptying. Thank you for being part of the boring currency community. Help us fight the fakes by leaving a comment, staying with the original. The middleman is broken, the price is liberated. Stay safe and hold the line. Welcome to the era of triple-digit silver. Subscribe.